Start.
My name's Danny Barron, CEO of Smarter Retirement, and I'm a curious investor. One of the things I've loved, what I've enjoyed greatly, is my 20 years experience in lending on first mortgages. Today I've got with me Martin Spicer, a licensed financial advisor who's had similar experience, and I'm going to discuss with Martin some of the advantages and disadvantages of first mortgages. Today's session is of broad financial interest. It is not personal advice in any way. I'm not licensed in any way to give financial advice, but I'd ask to introduce Martin Spicer, who's a licensed financial advisor. Martin, can you tell the viewers, please, what your credentials are?
Hi Danny, well I have a Bachelor of Commerce from the University of New South Wales. I'm a Chartered Accountant. I'm a Certified Financial Planner holding a Diploma of Financial Planning. I'm also a Director of companies that hold an Australian Financial Service Licence and Australian Credit Licence. I have a Diploma of Mortgage Lending, and I'm also a licensed real estate agent in New South Wales, Victoria and Queensland.
Okay, Martin, you're very well placed then to assist clients. Can you please tell the audience what you mean by lending on a first mortgage?
Well, lending on a first mortgage is where one or a group of people get together and lend to a borrower, and by way of security they receive a first mortgage over the borrower's property, be it residential, commercial or industrial, and also a personal guarantee. Interest is paid by the borrower to the lenders at a fixed rate. That rate is usually for 12 months. And as I said, securities by way of a first mortgage and personal guarantee.
So Martin, how long have you been lending on first mortgages, and what returns might you or your clients reasonably expect?
Well, I've been doing it for about 20 years, and generally the rates of interest that we receive vary from between 8 to 11%, depending upon the type of property that's put up for security.
Okay, Martin, it's interesting. We both have parallel experience. I've also been managing my own SMSF for about 20 years and also have been lending on first mortgages. Why then, Martin, might you recommend first mortgages to your clients?
Well, there's really two main reasons. The first is diversification. So if you've got property, shares and have cash in the bank, well, this is a great way of diversifying to get a better income return than what the banks are paying in either their own everyday accounts or term deposits. And then really it comes back down to the income yield. So in addition to diversification, as I've said, it's really a way of getting a higher return than even some of the managed funds are paying, and definitely what banks are paying.
So Martin, these higher returns, can you help the audience understand what a typical client might look like?
Well, a typical client generally forms as either a self-managed superannuation fund in accumulation mode, again where they want to have diversification, and part of the diversification is in an income return, and they want to get a better return than what the banks in term deposits. So that's in the accumulation phase. Also great for superannuation funds who are in pension phase, because in this case generally the interest is tax-free and the recipients really want to get an income return to fund a pension, and it's a great way of getting a certain level of income. And also just generally people who are retired, who may not be in superannuation, they may want to have some money in their personal names, they rely on an income yield. And finally, generally anybody that wants to have money sort of put away for at least 12 months and they want to get a better return than what the banks are paying in terms of the everyday accounts and term deposits.
So Martin, for this increased interest premium, can you broadly explain to the viewer what the risks involved are?
Well, Danny, the risks are inherent in lending on a first mortgage basis. So, for example, if the personal guarantees of the borrower are not sufficient to cover the debt, and there's a forced sale, there's a process of that forced sale. But at the end of the day, the risk is that if we are forced to sell the property, that the proceeds are not enough to cover the outstanding principal and interest. But generally, from my experience, it really would come down to a timing risk. Because at the end of the day, this process usually takes 3 to 12 months. And if you are expecting to have your money back in 12 months, well, the risk is that you may not. However, 3 to 12 months later, from my experience, you're generally going to get your principal plus interest, plus there's also penalty interest if the borrower is late or defaults.
Okay, Martin, just explain why the valuation of the property is important in managing the risk.
Well, the valuation is critical. At the commencement of every loan, a valuation is done by a licensed valuer who's not connected with the loan. And that valuation has to be on an as-is basis, which basically means, for example, if it's a piece of land, it's the valuation on the land itself. It doesn't take into account any future development, construction, etc. Same for any warehouse, commercial property, or even a residential house. It's the value of the property at the time that the mortgage was taken out, with no expectation of any future development, enhancement or improvement.
Okay, so Martin, I think you've very successfully explained the benefits of first mortgages today, and I'm very grateful that you've come and shared your wisdom and the experience you've had over 20 years assisting clients. So friends, my name's Danny Barron. As I mentioned, I'm not a financial advisor, and none of this is intended as personal investment advice. Today we've heard from an industry professional as to why first mortgage lending might be a suitable place to invest some funds. I'm very grateful today to Martin for his experience. I would again recommend that any financial decisions be discussed with your personal advisor, and none of today's information is meant to be tailored financial advice, but rather to assist you, as always, in planning both your wealth creation and hoping you enjoy a smarter, happier retirement. And thanks very much, Martin, for your time today.
Thank you.